Well, we just talked about ETFs, and the boom in passive investing is fueling the stock market rally. According to the Wall Street Journal, exchange-traded funds, or ETFs, spent $98 billion buying U.S. stocks during the first quarter, even as stock market valuations appeared high and other big buyers were stepping back. So, will ETF buyers continue to help drive this market higher? Michael Venuto is chairman of the Toroso ETF Industry Index, which tracks the performance of the ETF industry. Michael, welcome. Good to have you with us.
Thank you, Tyler.
So, do I need to be worried about this phenomenon? How big is it? 98 billion sounds like a lot of money, and by any measure, it truly is. But is it creating sort of bubblicious territory in the market?
I like that term, bubblicious, but this is really about the law of large numbers, right? The ETF industry has been growing at about 20% a year in assets for about 10 years. And at $3 trillion today, 98 billion is only about 3%. So it is a huge number, but in a percentage terms, it's within historical norms. It's part of the growth of the industry.
Mm-hmm. You know, not all ETFs, though, are created equal. There are some kind of hybrid ETFs that are out there. So as the investor looks at that landscape, and if indeed you're correct and we may see more expansion into this part of the market, what do you watch for?
Well, you got to watch and know what's in an ETF, right? Like, it's not just about what the name is. You have to know what is actually happening under the hood and how the process of creating the index works.
So when the money is put into an ETF, let's say a financial advisor says, I'm going to take your capital, I'm going to put it into an ETF because you get very good price efficiency, low expenses, you get diversification. All of that money has to get put to work across the index or whatever the benchmark is that the ETF is measured against or created out of. That really doesn't cause anybody to be discriminating into whether they're buying good values or not, does it? I mean, in other words,
no.
All of that money's getting put to work regardless of whether this stock is overpriced and that one is underpriced.
You're absolutely right. And in the broad-based indexes like the S&P or the QQQs, I don't think that's a problem yet. ETFs, on average, own about 6% or so of those kinds of names. But when you get into more niche-y things like REITs, for example.
Interesting.
REITs, for example, today, it's about 15% of the market cap of most REITs are owned by ETFs. And I think that's because investors are looking for yield, and ETFs are a better way to get them. So they go passive, and you have to watch that. That's a place where, to steal your term, Tyler, it could be bubblicious.
All right, Michael, we have to leave it there. We'll be back and talk more about this interesting story. Michael Venuto with the Toroso ETF Industry Index.